Assalamualaikum warahmatullahi wabarakatuh. My name is Nail Awatif binti Muhammad Asri from KBA 2423B. In this video, I am going to discuss about the value proposition that offered in Islamic finance, structure and mechanism of Islamic financial system in Malaysia, and also differences between the conventional and Islamic finance for the instrument of each institution. So, first of all, what are the Islamic finance? Islamic finance is the broad term used to describe a wide range of financial transactions that have been approved by a recognized authority as compliant with Islamic law. This means that Islamic finance is operates according to Islamic law, which is called Sharia, where it just like conventional financial system, as it provides the services like issuing fast check deposit, ATM cards, and also remittance. However, in Islamic finance, it is refers to how the business and individuals raise capital in accordance with Sharia or Islamic law, and this can be one of the value proposition for Islamic finance when it comes to the regulation that are governed both by Islamic law and the finance industry rules. The value proposition of Islamic finance is different from conventional financial system. This will look from the forward of profit through interest payment with the ingenious objective of profit maximization and makes the beneficiary completely liable for any risk. As their service is also consumer-friendly customer services that are meant to attract more customers. So these entities are very contrary for Islamic finance, where Islamic finance is the profit and risk sharing, which explicitly requires the appropriate due diligence and ensures that the profit is commensurate with the risk. The sharing of net profit or loss and the risk are involved in a proportional manner between the lender and the beneficiary. Therefore, if a financier is expecting a claim on profit of a project, it is necessary that he or she should also carry a proportional share of the loss of that project. The Malaysian financial system is made up of two components, the financial intermediaries and the financial market. At the heart of Malaysian banking is Bank Negara Malaysia, which is BNM, as the central bank of Malaysia. Malaysian Islamic banking system is operating side by side with the conventional banking system, and these will coexist and operate in parallel. This means that a wider and diversified range of Islamic banking products and services will be made available in banking institutions that offer Islamic banking. This is possible because there is not only an Islamic bank, but also other supporting banking institutions such as commercial banks, finance companies, merchant banks, takaful, securities firm, and saving institutions, as well as the rural cooperative bank. And their services are also available in the financial market, such as Islamic money market and also Islamic capital market. Islamic finance in Malaysia continues to demonstrate dynamic growth with a comprehensive Islamic financial system that is supported by robust regulatory, legal and Sharia governance framework. As such, the National Sharia Advisory Council, which additionally set up at Bank Negara Malaysia, that will advise the BNM on the Sharia aspect for the operation of these institutions and on their products and services. This establishment of BNM set as the authority for the ascertainment of Islamic law for the purpose of Islamic banking business, takaful business, Islamic financial business, Islamic development financial business, or any other which is based on Sharia principle and is supervised and regulated by the BNM. Islamic financial institutions have succeeded in creating trust in the eyes of depositors and receive deposits on profit and loss sharing basis, and in contrast with conventional banks as there will be a comparison for each financial instrument. This will be looked under the financial instrument of Mudarabah contract as well as Musyarakah for the Islamic financial instrument. For Mudarabah, let's see how it works. Contract of Mudarabah is specifies in advance how profit and losses are to be shared between the financier and the entrepreneur. Profits are shared in a predetermined ratio, so the financial return fluctuates according to business profitability, where the losses are fully borne by the owner of the capital, except those caused by the entrepreneur's fault or their negligence. Contrast that with a conventional loan where the financier has a contracted right to receive the interest and capital repayment, irrespective of the condition of the borrower's business. Now, let's take a look at the definition of Musyarakah partnership and also conventional partnership. So, for Musyarakah contract, it is a partnership whereby profits are shared as per an agreed ratio where the losses are shared in a proportion to the capital investment of each partner. The proposition of profit distribution is calculated according to the agreement of the contracting parties upfront. A fixed amount as a lump sum amount is not acceptable and will be on the amount to the guarantee the fixed return, and this is riba, which is prohibited in the Islamic finance. On the other hand, conventional banking can have fixed and predetermined return if agreed by the partner. Besides, in conventional and above the capital amount will earn 8% interest per annum, and these are very contrast as the interest payment is not allowed in Musyarakah contract, where if a partner want to enjoy any extra amount, they should extend additional capital and no guarantee of a repayment. In this Musyarakah, each of partner may enjoy any profit from therein, but they will have to bear any risk of losses according to the capital contribution. So, that's all for me. Thank you.